This is the Opening Market Podcast on the Iowa Agribusiness Radio Network. I'm Dustin Huffman, joined by Matt Bennett of agmarket.net. And Matt, it was a tough day for the grains yesterday, to say the least, and it's starting off negative today. What are we seeing on this Friday?
Yeah, there's no doubt that the summit between President Trump and Xi didn't go the way a lot of folks were hoping it would. I mean, essentially what we're getting from that is that the original soybean plan, if you will, 25 million tons per year, is something that we're just, I guess we're all going to assume that's what's going to happen. They said that they didn't have any more work to do there, but they're talking about other ag products. And so the trade took that as a negative because they were hoping, hey, maybe we'll get a few more beans sold to them. Maybe we'll get some other products like corn, for instance. I mean, we've been kind of looking at this lately, and U.S. corn definitely works into China right now. China's interior corn prices have been fairly stout. They didn't have the best crop last year, and so if they imported China into parts of the country, they could actually do so. And we've been hearing that they've been kind of asking around about U.S. corn. So none of that's happened yet. That did not go well yesterday as far as what the trade's expectations were. And then the other thing is that we've been pretty overbought here lately. So the market's definitely taking a breather here.
When we look at the Chinese situation, of course, we've heard really no solid commitments one way or the other here from the president as he leaves China. But also, this is the time of the year where China normally doesn't buy from us anyway. And so it doesn't seem like it's too far off to say that this is kind of normal until they would actually come back into the market where they need us.
Yeah, I couldn't agree more. I mean, there's no doubt that, in this situation, that especially on the bean side of things, I mean, right now, they're usually buying beans like it's going out of style out of Brazil. And so you wouldn't really expect them to buy anything unless they were essentially forced to. I think the trade was hoping that there'd be some sort of situation where they felt like they had to buy more beans in order to get what they wanted on the other side. So, it sounded like the biggest part of the conversation centered around them buying 200 planes off of Boeings, and I know that people in ag country don't necessarily want to hear that. But ag was definitely mentioned, where they said, hey, they're going to buy a lot of ag products. But, I mean, we've all heard that kind of stuff before. I think what everyone was hoping for was some sort of a signed trade deal instead of a handshake agreement, because we all know that those handshake agreements can flip on a dime.
Well, that they can, because there's no way to enforce those by any way, shape, or form. And, of course, while ag products are not heavily mentioned, and we see more about the Boeing situation, considering the rift we have, anything is in the right direction is progress, I guess.
Yeah, I would assume so. There's no doubt that China really wants to get this Strait of Hormuz situation figured out. They get around 50% of their energy directly out of that particular area, buy a lot of oil off of Iran. And so China's wanting to get that all straightened out. At the same time, the U.S. wants to make sure they're going to do the appropriate amount of business is what we think is appropriate. So there's a lot of wrangling going on. And obviously right now the markets, after having such a strong run here lately, really corn, beans, and wheat, we're all just sitting here kind of pulling back. I am watching closely, for instance, with like December corn. As we speak, we're trading below the 50-day moving average, and it's acted as really good support over the last several weeks. If we could close back above that, I'd feel pretty good about this. But as of right now, we're trading below it. So it'll be an important day here.
We've been so focused this week on that Chinese trade meeting and also on the E15 thing in Congress. What other things have been happening in that grain market other than what you're talking about with the D's corn?
Oh, absolutely. There's a lot of things that can happen here. When you look at the cash side of things, there's no doubt that, there's just a lot of good things going on from a demand standpoint. Whenever you look, for instance, corn exports remain extremely strong. We're in a position here where it sure looks like the USDA could have raised exports here this week, but they did not. They chose not to do so. And, essentially what you've got is right now shipments are running around 30% ahead of a year ago's shipments. That's shipped corn. That's not just sales. But shipments are around 30% ahead, and USDA is forecasting 14-15% increase in exports. So, our demand right now looks solid as can be. Of course, crush demand's been fantastic for soybeans. So, there's a lot of good things going on. I do think, especially on the corn side of things, with there being some question marks, as to how many of these acres of corn will end up being planted. I kind of feel like corn's got its own story without having to lean on something like, the Chinese demand story.
All right, moving over to the livestock side of things. It's been a kind of a volatile week for cattle, and the hogs have been just kind of up one day, down the next. What are we seeing there heading into the end of the week?
Yeah, I mean, volatile would be putting it mildly, Dustin. As you know, this thing's been all over the place. A couple of days ago, of course, fats were up $5, and then yesterday we tried to go even higher, made a new high from the previous day, but then we closed lower on the day. I think it looks like more of a consolidation type trade. If you look at the chart, it looks like we're going to struggle to go up and make new highs, but at the same time, we're fluttering up there awfully close. And then you look over at the cash side of things, cash market is just strong as can be, whether you're talking fats, feeders. And the other thing is, remember on beef demand, of course, is that you're in grilling season, and guys like you and I, we've been known to eat a lot of meat, so there's going to be a lot of folks, I think, that are going to keep this demand pretty darn strong here for the next several months.
And the thing is, though, it's interesting because we talked earlier, and we've been talking about this kind of throughout the week with the proposal of maybe removing the tariffs on beef imports. Obviously, we know cattle producers are making a decent money right now, but the thing is, the consumers are in a tough situation. As was mentioned on the House floor during the E15 debate, one of the representatives saying that a pound of beef is more than the federal minimum wage right now, and that's something that's got to be a little bit in the back mind on these marketing plans, isn't it?
Yeah, I mean, no doubt about it. I think where I get really concerned, Dustin, whenever it comes to cattle, is the guy that's going out trying to fill his pens right now. If you're buying those feeders and, you're not growing what you're feeding them. So if you're having to buy the feeders, buy the feed, and then try to find black ink out there on the deferred markets, that's pretty tough row to hoe. Whereas your front month, June, you're at 250, 277. You go out there to October and you're down at 239. And so, you can still probably find a little black ink in there if you're efficient. You don't have a whole lot of death loss, but at the same time, you've got to kind of step out on a limb of faith like the cattle producer usually does. I mean, a lot of these guys don't do much risk management. It's worked out well for them in most of their careers, but at the same time, you get caught on the wrong side of this, and it could end an operation pretty quick.
Yeah, I've been talking to a few of the feedlot farmers up back in Minnesota where I'm from, and they do grow their own feed, but even they're watching very carefully what they have to do and managing their marketing plans pretty close to the vest.
Yeah, I mean that's all you can do. I think LRP offers you a nice insurance possibility, and I don't sell it, so it's no plug or anything. I just know a lot of these guys that are run feedlots will use LRP, but just simply setting a floor in place around your break even to give you a worst case scenario of breaking even is probably a smart thing to do at the very least, because I am concerned whenever cattle do start coming north out of the country of Mexico. We know that's going to happen eventually. When that happens, it's probably going to change the dynamics a little bit.
And one last thing about hogs, we know that Mexico and Canada are considering changing some of their imports due to the pseudo-rabies cases that were found in Iowa and Texas. I mean, any more word on that and what effect that could have?
No, I mean, I haven't heard a whole lot on it, to be totally honest with you. I think this hog market, though, whenever you look at it, I mean, if you look at the cattle charts, if you look at the hog chart, I mean, it's two totally different worlds, whereas cattle, of course, went ramping up and then backed off and then went back up towards the highs. You look, for instance, at August hogs, and shoot, I mean, you're still fluttering $6-8 off the highs. And the thing about it is that you've got a lot of upfront demand, and I think a lot of that is some of your replacement type demand. So guys that are thinking about grilling this weekend, instead of spending $30 on a ribeye, they might spend 8 or 10 on a pork chop, and that's certainly understandable at times. And I think that's one thing that's kept us real strong up front. But man, you go on out just to October, for instance, you're clear down at 91.75. So definitely a front-loaded type demand situation here on hogs, and looks like prices should back off over the course of time.
All right, Matt. Well, of course, folks want to look at some of the intel you guys are watching, maybe get some input and some advice on what they should be thinking about for their marketing strategy. Where's the best way for them to get that ball rolling?
Yeah, it's just agmarket.net. Pretty easy to find. We've got all kinds of good resources right there on the website. So if they want to go there, maybe get our contact info and reach out to us, that's fine as well. But there's a lot they can access right there.
All right, Matt Bennett of agmarket.net joining us. Matt, thanks so much for the insight. We'll talk to you again real soon.
Yep, absolutely, bud. Have a good day.
July corn is down 8 cents at $4.59.5. December new crop down 6 3/4 at $4.84.5. July beans down 7 1/4 at $11.85 1/4. November new crop down 7 cents at $11.76.5. Soybean meal is trading up $8.50 at $3.41 even. Soybean oil is a penny higher at $73.67. Chicago wheat down 17 1/4 at $6.40 3/4. Kansas winter wheat down 15 at $6.90 1/4. Minneapolis spring wheat down 15 cents at $6.87 even. Hard spring wheat out of Kansas is 14 1/4 lower at $7.04. Oats trading down 2 3/4 at $3.59. Live cattle up $1.02 at $253.10. Feeders up 32 cents at $367.90. Lean hogs up a nickel at $99.57. Thanks again to Matt Bennett of agmarket.net for joining us. I'm Dustin Huffman on the Iowa Agribusiness Radio Network, where Iowa Ag matters. Have a good day.